Hi, everyone, and welcome to this episode of Money Moves. For this episode, I want to talk about the new CDC guidelines on mask wearing and how I think it relates to inflation. Then I'll go over each of my investing accounts, starting with Worthy Bonds, Yotta Bank, GroundFloor, Fundrise, my individual retirement account, my M1 Retire account, and Higher Yield Savings account. Then I'll finish up my investments with Robinhood and Tastyworks, and my bi-weekly tracker. Of course, there will be some jelly at the end, which is something I enjoyed outside of the markets. If you have big dreams like buying this mansion outside of Scottsville, Virginia, or if you're just getting started in your financial journey, definitely like and subscribe. This is the main estate and all of the land that comes with it. It has multiple dining halls, which I guess you could rent out, or if you have lots of friends because you're very rich. The main attraction is, of course, this go-kart track, and this distillery, and for the low price of $75 million, it better come with this helicopter also. Welcome to the Portfolio Bulletin. Let's get started. So the CDC basically declared the pandemic dead once they announced that vaccinated people do not have to wear masks, basically at any point in time, unless they're using public transportation, which includes buses and airplanes, but basically the rest of the time you don't have to wear a mask, which is definitely raising some concerns. The CDC said vaccinated people don't need to wear a mask or stay 6 feet away from people in most settings, to include in or outdoors. Disney and Wynn Resorts, as well as many states around the country, are easing their restrictions, and it's pretty easy to tell that this is based on the fact that inflation numbers continue to rise, and employment numbers missed pretty heavily this last month by several 100,000. There's criticism that this is because of the high unemployment benefits, as well as some fear around the idea of going back to work, and it looks like this is just a way to get people to go back to work and ease those fears, because inflation can definitely spiral out of control pretty quickly, especially when the government is continuing to propose massive spending bills, like a potential for more stimulus, as well as a pretty big infrastructure package. Business and health leaders said it's basically impossible to tell who's vaccinated and who's not, which is obviously the main concern at the ground level, but it seems like the government doesn't really care about that anymore, as they need to get people back to work and get this economy turning, especially if they want to spend all of that money they keep talking about. Disney quickly announced that they would raise their capacity based on the new guidelines, and I'm sure that most hospitality businesses are going to do the same thing, as of course having capacity limits does restrict their business from making more money, and as long as the CDC continues to support business in this way, businesses are going to take advantage of it. Of course, their calls for reducing the mask restrictions is definitely an incentive for getting more people vaccinated, but it's hard to say if that's going to work because I feel like a lot of people at this point who have not pursued a vaccine will most likely just take off their mask and pretend that they're vaccinated anyway. This does make it tougher on states and local authorities to fully align with the CDC because they think the CDC is moving a little bit too quickly, but it's also difficult for them to speak out against the CDC when that's what most people are looking to for their guidance. But of course, as I talked about in my previous video, you can see this is the CPI report, which is showing over 4% inflation over the last 12 months, which has been pretty dramatic of an increase from the lows of basically zero inflation during the pandemic, which in my opinion is starting to concern the government more and more, especially when they continue to try to spend large amounts of money in a short period of time. Moving over to my investments, starting with Worthy Bonds. No real changes here. I'm actually looking to draw this down maybe more here in the future. With inflation getting as high as it is, just under 4%, the actual buying power of Worthy is a little bit low at 5%. It is a hedge against inflation and it is still currently beating inflation, but there's potential that that could end. Otherwise, in terms of expansion, they're continuing to work on Worthy Capital 2. They also sent an email out to users saying that they are looking into more ways to invest, including music royalties, gold and silver, oil, and real estate, basically allowing you to invest in physical assets, which in my opinion is a good investment currently to hedge against inflation. Moving on to Yotta Bank. I don't talk about this every week, but it's definitely worth taking a look at as I continue to receive really good returns here, looking at over 2% here in May, and I've received quite a bit of prizes. It continues to outperform even the best savings accounts on the market, and it's just more interesting to look at. You can see all my savings bonuses as well as prizes here over the past couple of months. And I'm going to do a much larger in-depth review of Yotta Bank after the last couple months since I joined in October of last year, since I joined in September of last year. And if you are a Yotta member, you should definitely check out my pool, the Portfolio Bulletin. This is a public pool where we all put our tickets together and hopefully win a little bit more money than we would otherwise. And you can see the invite code is there with the Portfolio Bulletin with no spaces. Speaking of physical assets, moving over to GroundFloor, you can see I continue to raise my account value here, and I'm continuing to get actually a little bit better than 10% returns. And I've had 6 notes repaid and made a couple of dollars here, with my current expected earnings to be just over $265 once all of the notes that I'm currently invested in get fully repaid back. I also got my first default here, which looks like this. You can see performance in default, and it says that the investor is trying to refinance the loan through a traditional bank, stating that the project is actually done, but they're waiting on final appraisal to refinance the GroundFloor loan, which would pay GroundFloor back and then transfer that loan and then transfer that title over to a bank. So I'll have to keep an eye on this to see exactly what happens, but hopefully I don't get my first default. Moving over to Fundrise, I don't have any real changes here. This continue to do all of the work and continue to add projects to my portfolio. Certain projects are continuing to be added, as you can see here. Different apartment building complexes. You can see this one's actually a completed apartment building. Another apartment building here successfully paid back. And then this looks more like a townhome development, single family rental development here in Texas. And then another project here completed in LA. So you can see that they're continuing to do good work. And this continues to be a pretty large percentage of my overall portfolio. And I'm finally getting real estate pretty close to that 20% overall, which is part of why I was investing so heavily here in Fundrise. Moving on to my TSP, you can see the balance here just over 79,000. Currently, I'm putting most of my money into the S&P 500, as well as a little bit less than half into the total stock market fund. I'm currently not buying bonds because they tend to underperform in times of inflation, and also yields tend to go up during times of inflation, which means the value of these bonds will go down. So currently, I'm not buying any G or F fund. Currently, I'm not buying any of the G or F funds because those are bond indexes, and I'm not really interested in owning those right now. Moving over to M1 Finance. Gained a little bit over 2% this week. Some of that is in dividends and some of that is market gains. Overall, tech was basically flat. Finance improved, as you would expect, with the potential for higher rates going forward. Healthcare also improved. Dividend ETFs, right in the middle. And then telecom actually did pretty well. I think this is mainly because AT&T is doing very well here recently, as their outlook continues to improve in my opinion. Otherwise, the top performers here in healthcare for me, Johnson & Johnson did very well. Really, all of them did pretty well. United Health, AbbVie. Underperformers here are Medtronic as well as Merck & Co. But otherwise, everyone's doing quite well over the past month. And then finance, as you would expect, did pretty well, except for Main Street Capital, as well as PayPal Holdings. I only bought one share here, and this is a pretty recent purchase. If I had bought it when I bought all of these other things, it would probably be up right now. But as you can see, all of the main ones, Goldman Sachs, JP Morgan Chase, Bank of America, all continue to do very well. Moving over here to my higher yield savings, also up 1.75%. Top performers here, VIG doing very well. Bank balance sheets are down as you would expect. As inflation goes up, bond prices tend to go down, but they've held up pretty well here, staying pretty flat, only down a very small amount. Corporate debt was the largest underperformer, and the Vanguard True Value was the top performer for this. As you would expect, this is the blue chip stocks of the S&Ps, and they are starting to outperform much more than growth here recently. Looking at the last month here for Robinhood, up around 5%, but I was down quite a bit here in the middle of March, as I was anticipating a little bit more of a dip here in the markets, and I was a little early, and then I did recover here a little bit into May, and then dipped a little bit here into the middle of May. Otherwise, still doing very well overall. And you can see I have quite a few oil plays right now. If you didn't check out my oil video, you should definitely look at that. I think oil's in a position to continue its rally forward. And some of the easiest plays here are USO and SLB, in my opinion. Moving over here to Tastyworks, you can see I've had a pretty rough patch here in my individual account, but I do think that I'm going to be able to turn this around here going forward, as I've redeveloped my strategy, and I will be talking about this more in the future, so definitely hit the bell to make sure you don't miss out on any of that content. Otherwise, my largest plays here are being short bonds here. This is the 10-year bond note futures, as well as pretty neutral on oil here, but slightly bullish going forward. And these are oil futures, which don't trade exactly the same way as oil companies, but as I mentioned, I'm still slightly bullish. Another thing to mention here is Roku. I'm actually short Roku because this is a growth company, and it seems like the growth trade, which has benefited from the pandemic, is basically dead. And all of those kind of growth stocks have returned to relatively reasonable values, but are not showing any bullish signals yet. Moving over to my biweekly tracker, you can see we're just off of our highs here for stocks, and I took a little dip here in my trading accounts. As I mentioned, I'm kind of revamping my strategy here a little bit, and hopefully we can see some improvement in the next few months. Otherwise, real estate continues to trend up pretty aggressively, which is my primary focus in terms of long-term investing right now. Bonds uptick just slightly, and Lending Club is continuing to trend down, and my cash is right where I need it to be. Overall, down a little bit over the past 2 weeks, and this is primarily due to my trading account as I continue to look at this investing strategy. Let me know down in the comment section what you think of my current investing strategy and what you think of the CPI data and taking off masks if you're vaccinated. Definitely like and subscribe if you got any value out of this video. Of course, none of this is financial advice. This is all for entertainment purposes. And with that, let's get to today's jelly. So Tom McDonald has been the jelly before on this channel, but he recently released a video where he bought an NFT from Eminem for $100,000, and it came along with a track produced by Eminem, and then he rapped over it and released it. And if you like Eminem and Tom McDonald, this is definitely a great song worth checking out. Of course, he's a pretty non-conventional guy, so definitely be aware of that. But if you like his kind of music, definitely check this out. Comment down below what you thought of it if you go check it out, and have a great day.